Here is a question worth sitting with on Wednesday, July 29, 2026. Why are speculators piling back into copper at exactly the moment when analysts keep calling this rally unsustainable? That is the tension at the heart of ING's commodities research published this morning, which flags that speculative long positions in copper are rising again, and pins the reason firmly on tight supply. This is not a story about hype or a meme trade. It is a story about physical metal that simply is not arriving in the volumes the world expected. Copper spent the first half of this year in what Marex described as metals madness, with record highs, a violent sell-off, and renewed talk of a supercycle. Back in January, Yahoo Finance was already reporting that copper had surged in what many desks called an unsustainable rally, joining silver and gold in a broad metals frenzy. 6 months on, the speculators have not gone away. They have come back. And the fundamentals underneath them have, if anything, tightened further. Let us be precise about what a rising speculative long means. On COMEX in New York, the Commodity Futures Trading Commission publishes weekly commitments of traders' data showing how money managers are positioned. When ING talks about speculative longs rising, it means that net bullish exposure among funds and non-commercial traders is expanding, either by adding new long contracts or by covering shorts. This is not an isolated observation. On July 20, 2026, TD Securities was reported making a very similar point, that copper speculators were rebuilding long positions specifically because the supply picture was tight. 2 independent research desks reaching the same conclusion within 10 days matters. It tells you the flow is broad rather than one fund making a concentrated bet. The important nuance is this. Positioning data is a sentiment gauge, not a forecast. A crowded long tells you conviction is high, and it also tells you the market is more vulnerable to a sharp unwind if that conviction is tested. The supply story is where this becomes concrete. Copper mining suffered 2 major disruptions in 2025 that are still working through the system today. At Codelco's El Teniente in Chile, one of the largest underground copper mines on the planet, a collapse on July 31, 2025 killed 6 workers and forced a lengthy suspension. Then in September 2025, a fatal mud rush at Freeport-McMoRan's Grasberg complex in Indonesia triggered force majeure and slashed expected output, with the effects reaching well into 2026 production guidance. These are not small operations at the margin. They are among the biggest single sources of copper concentrate in the world. Add years of falling ore grades across mature Chilean and Peruvian mines, and the result is a concentrate market that cannot keep up with global smelting capacity. That is the tightness ING is pointing at, and it is measurable rather than theoretical. Here is the clearest single indicator of how tight things are. Smelters normally earn treatment and refining charges for turning concentrate into refined metal. When concentrate is scarce, smelters compete for it and those charges fall. Through 2025 and into 2026 they collapsed and in many spot deals turned negative, which means smelters were effectively paying miners for the privilege of processing their material. That is an extraordinary inversion of a normal industrial market, and it does not happen unless raw material is genuinely short. Layer on top of that the American Section 232 copper measures. A 50% tariff on semi-finished copper products took effect on August 1, 2025, with refined cathode initially spared and facing a phased tariff later in the decade. The anticipation of those measures pulled enormous volumes of copper into United States warehouses ahead of the deadline, draining metal from the rest of the world and widening the price gap between COMEX and the London Metal Exchange. Global stocks did not disappear, but they ended up in the wrong place. This is not an abstract exercise for traders. Copper is the metal of electrification and the demand side is relentless. An electric vehicle typically contains several times more copper than an equivalent petrol car, and every grid upgrade, substation, wind farm and data center expansion consumes it in bulk. The artificial intelligence build-out has quietly become a serious copper consumer, because power distribution inside a hyperscale data center needs enormous quantities of busbar, cable and cooling infrastructure. For British households and businesses, expensive copper feeds through slowly but reliably into electrical installation costs, plumbing, construction budgets, and ultimately network charges on energy bills. For manufacturers, it squeezes margins on everything from motors to transformers, where lead times were already long. And for anyone holding a diversified portfolio, copper equities and miners have been one of the standout performers of the 2026 metals frenzy, which cuts both ways when positioning is this crowded. Copper does not trade in a vacuum, and today's wider commodity picture reinforces the point. ING's own commodities feed on July 29, 2026 leads with oil rising as Middle East tensions reignite. That matters for copper in two direct ways. First, mining and smelting are extremely energy intensive, so higher fuel and power prices raise the cost floor under the metal. Second, a firmer energy complex tends to lift inflation expectations, which historically supports investor appetite for hard assets across the board. We saw a version of this in March 2026, when ING reported Brent consolidating above $100 a barrel as supply disruptions persisted. When energy is expensive and geopolitics is unsettled, commodities as an asset class attract flow. That is part of the fuel behind the speculative long building in copper right now, alongside the physical shortage. So what should you actually watch over the coming weeks? 3 things. First, exchange inventories on the London Metal Exchange and in Shanghai. If visible stocks keep drifting lower, the tight supply argument holds and the longs stay put. Second, the weekly positioning data. If net length keeps climbing without a matching move in physical premiums, that is a warning sign that the trade has become financial rather than fundamental. Third, Chinese demand indicators, because China consumes roughly half of the world's refined copper and its property and grid spending remain the single biggest swing factor. The realistic near-term path is continued volatility rather than a smooth climb. Structural deficits are widely forecast for the rest of this decade as electrification demand outruns new mine supply, but crowded positioning means sharp corrections can arrive without warning, exactly as the market experienced earlier this year. Here is the memorable version. Coppa's bull case in July 2026 rests on something real. Damaged mines, negative treatment charges, tariff distorted stock flows and structural electrification demand are all documented, not speculative. But the speculative longs ING flagged today are a consequence of that story, not a confirmation of it. Crowded trades amplify moves in both directions, and the same tight supply narrative that draws money in can leave the exit very narrow if Chinese demand disappoints or if disrupted mines restart faster than expected. If you take one thing away from Wednesday, July 29, 2026, make it this. The metal is genuinely short. The positioning is genuinely stretched. Those are two separate facts, and confusing them is how investors get hurt. Watch the inventories, not the headlines, and keep an eye on the energy backdrop that sits underneath the whole complex.